Ladies and gentlemen, good day and welcome to the General Insurance Corporation of India Limited Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. Now I hand the conference over to Mr. Sarda from Ernst & Young. Thank you, and over to you, sir.
Thanks, Rayo. Good afternoon to all the participants on the call, and thanks for joining this Q1 FY24 earnings call for General Insurance Corporation of India. Please note that we have mailed out the press release to everyone, and you can also see the results on our website, as well as it has been uploaded on the stock exchange. In case you have not received the same, please write to us and we'll be happy to send it over to you. Before we proceed with the call, let me remind you that the discussion may contain forward-looking statements that involve known or unknown risks, uncertainties and other factors. It must be viewed in conjunction with our business that could cause the result, performance or achievement to differ significantly from what is expressed or implied by such forward-looking statements. To take us through the results of this quarter and answer our questions, we have with us the management of GIC, represented by Mr. Devesh Srivastava, Chairman and Managing Director, and the top members of the management. We'll be starting the call with a brief overview of the quarter gone past, which will then be followed with a Q&A session. With that said, I'll now hand over the call to Mr. Devesh Srivastava. Over to you.
Thank you, Mr. Sarda. Good afternoon, everyone. I am pleased to announce the financial performance for the quarter ended June 30th, 2023. Over the past few years, our teams have diligently worked to refine our underwriting practices, and we have constantly focused on improving our combined ratio on the back of our unwavering commitment to enhancing profitability and fostering sustained growth. We believe that the increase in combined ratio during the quarter is temporary, and we are confident of much lower levels in the coming quarters, led by our relentless pursuit of operational excellence, strategic initiatives, and prudent risk management practices. By strategically managing risk and maintaining a balanced portfolio, we continue to position ourselves for long-term success. Let me now take you through some of the key highlights of the financial performance. The gross premium income of the company was rupees 8,917.71 crores for Q1 FY24 as compared to rupees 11,021.83 crores for Q1 FY23. The investment income increased to rupees 2,454.94 crores in Q1 FY24 as compared to rupees 1,890.43 crores in Q1 FY23. Incurred claim ratio stood at 95.1% in Q1 FY24 as compared to 94.7% during the corresponding quarter of the previous year. The combined ratio in Q1 FY24 stood at 118.47% versus 110.97% during the corresponding quarter of the previous year. The adjusted combined ratio, taking into consideration the policyholder's investment income, works out to 97.24% for Q1 FY24 as compared to 97.01% in Q1 FY23. Profit before tax stood at rupees 935.18 crores in Q1 FY24 as against rupees 988.71 crores in Q1 FY23, and profit after tax stood at rupees 731.79 crores in Q1 FY24 compared to rupees 689.72 crores in Q1 FY23. Solvency ratio increased to 2.88 as on 30/6/2023 as compared to 2.14 as on 30/6/2022. Net worth of the company without fair value change account increased to rupees 32,984.27 crores on 30/6/2023 as against rupees 26,345.14 crores as on 30/6/2022. Net worth of the company including fair value change account increased to rupees 69,650.29 crores on 30/6/2023 as against rupees 55,331.65 crores as on 30/6/2022. On the premium breakup, domestic premium for Q1 FY24 is rupees 5,547.35 crores and the international is rupees 3,370.36 crores. The percentage split is domestic 62% and international 38%. There is a degrowth in the domestic premium by 30%, while the international book has increased by 21%. We firmly believe that the current market conditions, which is going through a hardening cycle, combined with a prudent risk assessment, disciplined underwriting practices, and well-executed strategic initiatives, will help us in achieving a more favorable risk profile and positioning us for sustained growth. We are optimistic about the future and confident in our ability to seize emerging market opportunities while navigating potential challenges. As we move forward, we remain committed to upholding our values, delivering exceptional service, and achieving sustainable growth. Having given the highlights, now we will open the floor for questions from the interested parties. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions, press star and 1 on their telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Sanket Godha from Avengers Spark. Please go ahead.
Thank you for the opportunity. Sir, my first question is on the growth. There is a significant drop in the crop insurance business. For example, last year you did around 2,700 crores of business in crop, and today you did only 620 crores in the same quarter. It's more to do with the timing difference of recognition of premium, or the country, most part of the country has adopted the 80-110 rule, and therefore this crop business has not come through the insurer. I just wanted to understand why it led to say fall.
Sure, Sanket. We are happy to ask our CFO to give this. This is, as we mentioned in the notes as well, largely due to an IRDAI circular in which there is a change in the way we are to estimate our premiums, and that is what has led to this appreciable drop. So our CFO, Mrs. Ranade, will take you further on to this so that you can understand where it's coming from.
Good morning, Sanketji. This is Jayashree Ranade. Actually, if you see in our note number 10, we had mentioned that there is an overall, we have modified our estimate accrual policy based on the IRDA circular. Now, this circular, this circular states that you can estimate only for a quarter. It means no what is permitted, and at the same time, it has to be equal for all the portfolios. I mean, portfolio-wise, you cannot vary it. Now, crop being a different kind of insurance kind of business, we earlier used to take it on the basis of our estimated premium income in the treaties, etc. But now that even obligatory, we have to consider certain benchmark figures given to the GI Council. So based on that, we calculated crop insurance premium for this particular quarter, because SOAs, the statement of accounts, will be received later.
Right.
There is a drop shown in this quarter. I'm sure going forward, these figures will increase based on the firming of these kind of figures, which are the base for our accrued premium calculations to match the IRDA regulations. So, this time there is a drop which is shown, but roughly around 800 crores plus is kind of because of this change in the methodology in the crop itself. Yeah.
Okay. So you mean to say that, ma'am, if you could have used the old method of accounting of crop, that number would have been closer to 1,400 crores rather than being at around 600 odd crores that you have reported. That's the way I should understand, ma'am?
Yes. It could be slightly even more than that, but we have made a conservative calculation of those numbers, and it will be in the range of 1,500-1,600 crores. But since we changed the methodology for crop, this is what it is. In fact, if you see in the note number 10, we have told that we have given the disclosure also. Total impact of this change is 1,664 across all the classes, mainly domestic. So, hence, I mean, yes, going forward in the next quarter, this crop figures will collate into GI Council figures. So my obligatory will also go up. Even our SOAs will come, which will give me the 100% figures, etc. No, these are the modalities of our business, how the accounts are being taken into the books. So going forward, this figure will match up with kind of last year's figures.
So which means from full year point of view, last year we did around 5,000 crores of crop business. So a similar number we can expect to be continued for the entire FY2024.
Sanket, it is here.
Yeah.
I think as Madam explained, the major driver of the figure is the premium estimation policy. The second important factor is the change in the market structure in terms of some of the states moving to alternate surplus sharing models, shrinking the premium. Apart from that, there is also softening in the market. I think part of the reason is the EOM circular encouraging some cedants to benefit from the way the EOM stipulation is to be reckoned by IRDA. Given the softening and the size of the market shrinking, there is some step back by GIC. So it is summation of all these four factors together. The first is the premium estimation, second is the movement of states, third is the softening because of EOM, and fourth is, since the pricing has become less effective, a little step back by GIC.
Okay, got it. So, which means that compared to last year, given the market is not conducive, and also the market price for the reinsurer have shrunk because we have adopted 81 rule. Then can we expect this number to be maybe decently lower compared to the last year? Like if you have done 5,000 crores last year, this year number could be, from a full year point of view, I'm saying, this number could be lower, as low as 4,000 crores or much lower than this, sir?
I think what you have mentioned is a decent figure. It can be lower by 15 to 20%.
Got it. Perfect. And the accounting rule is not just only limited to crop, it is applicable to all products, right? That's the reason we see decline in most of the products except for the motor business in the second quarter.
Yes, Sanjayji, yes. It is applicable to across the portfolio, domestic as well as foreign. So that modified methodology is applicable to all portfolios.
And then there any reason, ma'am, why motor has been such a strong growth, 35% year on year?
Foreign is grown.
Okay. It's more to do with the foreign business rather than the domestic business. Right? Yeah. Okay, ma'am. The second question which I had was, if you can quantify the combined ratio deterioration because of cat event. In domestic, we already had one cat event. And in overseas also, I see loss ratio, combined ratio to be meaningfully higher compared to what we had as a combined ratio in last year in the same quarter, around 119 becoming 151, and domestic has marginally deteriorated from 108 to 111. So should I read it as more due to the cat event or if it is just what is the quantum of loss what you have booked?
Sanjayji, one reason for foreign portfolios combined ratio increase is it's basically around 400 crores of dent due to exchange loss. Of course, it is notional. Last year there was an exchange profit, and this year there is an exchange loss of 60 crores.
Okay.
This is one reason for domestic's little worsening of that combined ratio. nearly 400 crores. As regards domestic portfolio, sir, domestic is a small variation is there from 108 to 111.
Okay. Yeah, ma'am. But the Gujarat floods, did it impact any numbers? Gujarat one, I meant to say, not floods. Impact any impact if you want to quantify which led to the deterioration in the combined?
I'm Satish Bhatt here. Not much because we have not yet received much of the information. There are two things. One was the Biparjoy cyclone and the Uttarakhand floods. So we have made an implicit provision. So maybe in Q2 we will have a clearer picture as to how much is attributed to that. But yes, to answer your question, we have slightly increased the loss ratios for property portfolio. But that is not the main reason why the slightly higher. That could be one of the reasons why your incurred loss ratio is higher for domestic portfolio.
Okay. But would it be okay to quantify the provision what you have made for CAT or already reported CAT in the quarter one?
No, we have not done any explicit provision. See, what happens is to make a provision, you need information that will be flowing from the cedents. So in the absence of any information, what we do is that the loss ratios that we consider for reserving, we do a markup on that, maybe 3-4% markup on the loss ratios to ensure that we have made some provision in Q1 itself in the absence of any information flowing from the cedents. So we will be able to quantify it only in the next quarter.
Okay, got it, sir. Got it, perfect. And ma'am, the exchange loss means if you it's notional, right? Means if the currency behaves properly at the end of the year, then this combined ratio of 131 in the overseas business will not remain to the extent, right?
Sakyaji, yes, this is one kind of factor for which the loss is increased. If you see the actual thing. Apart from that, motor and cargo has given little increased losses in foreign portfolio. Yes, going forward by end of the year, if exchange is there is a small difference, 82 point something and 82 point something. That is why this loss has come. So because it is appreciated, Indian rupee is appreciated a bit. Going forward, if it is kind of again a little bit this depreciation, this will again exchange will be taken care of with this calculation. Yeah.
The reason why I'm asking ma'am this question is that we have been highlighting that our overseas book has seen a decent amount of price hardening. We highlighted that point in the last quarter too. But the trend I think seems to be encouraging at least in the overseas business from first quarter number. So that's the reason I was just trying to check it's only because of currency or even we can see a better combined ratio in the overseas business eventually.
The thing is that all the liabilities for the claims for all the period, total OSLR and IBNR get back to the new exchange rate. So, though we benefit for say January renewal on the exchange inward business for the period, the cumulative liabilities get reassessed at a new exchange rate and it definitely creates a huge impact. Second variation can be attributed to the fact that even a small variation, say a 2% variation on a given quarter, given the small premium base gets pronounced for the given quarter. I think we have consistently maintained a stand that given the seasonal nature of the GHC book and certain seasonal bookings and catastrophe being seasonal, it is not desirable to look at quarterly results. You have to look at quarterly results with certain caveats.
Got it, sir. Got it. And last two questions from my side. One, just wanted to understand how do we read the current increase in the commission ratio in the quarter? Relatively, it is much higher, around 52% as a percentage of net premium. So just wanted to understand why is it the case? Is it because the overseas contribution has gone up compared to the last year? Point number one. Or anything else we need to read into it? And then second, second question just on a bookkeeping. Wanted to break down your investment book into capital gains and other income. Other income is dividend / interest income.
On the first one, regarding the higher commission level, I think we have discussed this earlier that on the US book, we have stepped back. But due to various legal aspects, certain bookings were delayed and the contracts which we walked away from had a higher commission level. So because of delayed booking, there is a delayed impact, trailing impact of these particular contracts, which is impacting the current quarter. We hope that it should soon revert to the earlier commission level.
Oh, okay, sir. And lastly, on the investment breakup.
Okay. Sir, regarding interest income?
Breakup is capital gains and interest and dividend income, ma'am.
So the interest income was 1255 crores as against 1069 crores of the previous year. Dividend is 208 crores as against 133 crores of the previous quarter, 30th June 2022.
Yep.
And profit on sale is 802 as against 589 crores.
Okay, ma'am. Perfect. Thank you. That's it from my side.
Thank you. The next question is from the line of M.W. Kim from JP Morgan. Please go ahead.
Thank you so much for this opportunity. So I have a two questions. The first question is about the risk management. So I noticed that overall the underwriting looks not really a good stage compared to the global reinsurers. So I just want to understand about your risk management practice. So in this year's renewal, did you make that the bigger the increase of the main excess of loss XOL limit to make that the potential the tail risk the manage better? So that's my first question. And then the second question is about the overseas motor underwriting. So based on my understanding, the overseas motor is considered the underwriting strategy due to the low correlation with the natural catastrophe event in general. So I just want to understand that a really bit more spike on the claim ratio and also that the outlook on the overseas motor. Thank you.
On the risk management practice, what exactly are you wanting from us? We were not very clear on that.
Yeah, sure. So I want to know that whether you increase the XOL, excess of loss point, the case that the overall in a big mega event, you can make that your underwriting is not really have the big harmful. That's my question.
Okay, no, on that count, our deductible has remained the same from the previous year. There is no change at the point at which we purchase retro insurance. That has remained the same. Does that answer your question?
Yeah. So in case of now that the world weather is already different compared to the history, maybe too hot and then more frequent flooding, etc. So I just want to understand that compared to the old that underwriting, do you have the more sophisticated underwriting to manage that tail risk which may happen in every 100 year or every 250 year, or you have the internal model to managing that risk then?
So that, of course, you see, our pricing strategies are at work and our pricing tools are used, of course. So if you're talking about, the change in the weather pattern that we are seeing, we had taken care of this in our previous quarter ending when we built up a catastrophic reserve, which was a healthy amount that we started with, and that is going to hold us in good stead as we move forward. So in the event of any vagaries of nature that hits our book, we will have that reserve that will come to our rescue. Does that help?
Yeah. Thank you so much. That's very clear.
And on the motor book, Yes, motor does give you the diversification. So essentially, it is just one contract that we are speaking about. I'll request Mr. Joshi to explain it further.
I think we had mentioned maybe 2 or 3 quarters back that given the experience of our US book, we decided to step back and we are reevaluating our position. And we will be again emphasizing the motor book, and as you rightly pointed out, it does offer a good diversification. But we are taking a pause for the moment in a particular market.
I see. Yeah, that's very clear. Thank you so much.
Thank you. The next question is from the line of Supratim Datta from Ambit Capital. Please go ahead.
Thanks for the opportunity. I'll start off with the mark size line. So in life, you see that, the domestic side combined ratio has increased significantly from 82% last year to around 180% now. Just want to understand what is driving this, and could it result in another cycle of hardening when it comes to, the insurance rates next year? That's question number 1. Question 2 would be on the combined ratio outlook that you expect combined ratio to improve at the company level from the next quarter onwards. Just wanted to understand what gives you the confidence given, the losses that we have seen due to floods in northern India and during this quarter, particularly in July. So what gives you the confidence, and currently what kind of claims or run rate and which categories are you seeing losses being due to these floods? So that would be question number 2. Question 3 would be, given we have already seen 2 accidents this year, do you see the insurance rates on the general insurance side starting again next year? So those are 3 questions. Thank you.
Let me start with life. There is a definite reserve strengthening that is impacting the higher combined ratio and the higher ICR, but we expect that over the period of time it will get fairly muted.
So this does not require any kind of action. I understand that.
Yes. Coming to the catastrophe, I think the entire world is watching in terms of what is happening on the climate change side, and it is getting more and more headlines in different parts of the world. So the broad consensus presently is that climate change is here to stay. It is much nearer than we had thought and planned for. And presently, despite some additional capacity which has come forth, we expect that the hardening of the reinsurance rates, particularly cat rates, will continue to be solid. The market discipline as for July renewal continued to be there, despite some increase in appetite of the risk carriers, as also more retention by the cedents. Market discipline is held up for July renewal, and we expect it at least to continue for 1 more year.
Got it. And on your the output for combined ratio for this year, that you expect it to improve. So what gives you the confidence in the flood, and if you could see details more initially where you are seeing the impact of the floods.
I think we expect, based on our various underwriting measures and discipline and process improvement that we have carried out, that we will be improving in our underwriting performance year to year. This is of course subject to no major cat event which is fully exposing our net, tweaking the results. So given the trajectory that we have started out for ourselves, we do expect year on year there will be improvement.
Thank you. Before we take the next question, a reminder to participants that you press star and 1 to join the question queue. The next question is Anirudh Agarwal from ValueQuest Investment Advisors. Please go ahead.
Yeah, thanks for the opportunity. My first question was on the international domain. If you could share X of the forex impact and the US impact that you saw higher commissions, what would the combined ratio have been in the foreign book?
Mr. Anirudh, if you see, in case of foreign book, our combined ratio is somewhere around 131%.
Right.
Of which approximately from the last year, if you see, last year there was a exchange profit of 350 crores. This year there is a loss of 59 crores. Okay. So this is a major change. So if you reduce 59, of course that will be a small impact.
Right.
Apart from that, the claim ratios have increased a bit by 10%. And as explained by Hitesh sir, the commissions for those contracts which have gone up, which has some impact. So these are the reasons for foreign portfolios, increase in the combined ratio.
Right, and the question basically comes from, we have been seeing that there has been a 20 to 40% hike in international prices in the January renewal, right? And that was expected to significantly bring down the combined ratios from where we were operating earlier. But as I understand from your point, there is not a very significant impact of the forex loss or the old contracts in this 150%. So claims of course have gone up, but ideally shouldn't the price increase have countered that benefit and loss ratio should have remained where it is instead of going up?
The price increase that you are mentioning is essentially on the property cat side, though it has had knock-on effect, domino effect on all classes, but then it is essentially on property side. Our result is presently majorly impacted by the motor foreign adversely impacting, and motor foreign has its own dynamics. It does have a influence of the wider market, reinsurance market trend, but then that is not impacted and it is not hardening to the same extent as what other classes have seen. So to see the improvement in our performance, the hardening of the rate at January, you need to look at property and not at motor. Motor is where what we explained about a particular contract and a particular trailing and runoff effect of the particular contract and delayed booking which I mentioned.
If you could share the quantum of that impact of that contract.
I think it will be difficult, I think.
But broad number, 100 crores, 200, 300 crores, any sense of it?
If you can just superimpose motor figure for the current quarter over the previous quarter, you will get a good idea.
Got it. Okay, understood. So on the domestic side, how are you looking at combined ratio improvement as we go ahead? Because obviously on the domestic side also there is some amount of hardening that has already happened, and still broadly the combined ratio has only gone up versus last year. So what is the path that takes us to a 100% combined ratio in domestic? Obviously now some parts of the weather changes and NatCat are going to be an everyday occurrence, the way climate change is moving and so on. So how do we get to a 100% combined ratio in domestic?
I think whatever we have been doing, we have to continue on the same path. The only thing is that when the correction required was fairly huge, it could not have been done in a single year. And again, given the nature of the reinsurance business, where when a decision is taken, almost it takes around 8 quarters on a proportional treaty to get the changes in underwriting getting reflected in the financials. So it is the same thing essentially that entire world market, all risk carriers, whether it is retrocessioners or whether it is reinsurers or insurers, I think every single player in the risk management market is alive to the challenge of climate change. If you have read the recent headlines, I think from 1st April, there is an increase of 25% loading on the STFI rating. So market is alive and reacting to this. Though there was a relaxation on the main fire cover, there was a loading on this cat component of the premium by 25%. So I think market will be reviewing the position. All the carriers will be alive to the situation and will correct itself.
But Mr. I want to add to what Mr. Joshi just said. If you see our 22-23 entire year results, our domestic combines are totally under control and within 100. Even in this quarter, we see that our combined for the domestic is below 100. So domestic is now totally under control. It is a foreign book that we are working on, and as mentioned earlier, there have been these 3 contracts that are not recent. They are earlier contracts which are now, coming to a certain stage of maturity, and those figures are what is, playing the party pooper, so to say.
And so these contracts, Q1, we have taken all the impact now, or there is more to come next 1 or 2 quarters?
So largely the contracts were taken into account. It's only that the bookings are now maturing and therefore there is a lag. There is a delay in the booking of earlier years. That is why that is the number that is being reflected now.
Right. And some amount of bookings you are seeing will happen over the next 1 or 2 quarters as well. That's how I should think about it.
Yes, because the tail is still carrying on.
Understood. Okay, and any outlook on the investment income for this year, given how it's been performed?
Hello.
Yeah, go ahead.
So I'm the CIO. Yes, equity income we still, as the markets will be on the rise for some more time, we will be booking some profits from sale of securities. Will definitely be there, and we have a very stable fixed income portfolio also. 53.9% is in sovereign securities, and so out of that 73% is in fixed income securities only. So there will be a stable investment income also. So interest income is also likely to go up.
Right, understood. And finally, any update on the credit rating side?
So, Mr. Agarwal, we had our rating exercise. They had come in the second week of July, and we had long discussions with them throughout the day. So let's see. The toing and froing of questions is going on, and we should be able to hear from them. We are optimistic because they also acknowledge the fact that a lot of work has been done, and the numbers speak for themselves.
Understood. Got it. Thanks a lot. That's it from me.
Thank you very much. A reminder to participants, you may press star and 1 to ask questions. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. Well, that was the last question in queue. I would now like to hand the conference back to the management team for closing comments.
Thanks everyone again for your time, and we are on a very set about path where we had made our decisions and we just adhering by them, moving forward on a very thought of way forward, and that is what is getting us the results. And this trend is going to continue because, as we had earlier also mentioned, that it is a trend that you have to set in motion, and then it takes time for it to actually translate into numbers. So whatever we did 4, 5, 6, 7, 8 quarters ago is now getting into action, and those numbers are showing, and we hope to continue this trend. We have made a lot of course correction even in this time on the 1st of April renewals, which will hold us in good stead as the year develops. So we look forward to continue to make our portfolio much easier and deliver better results quarter on quarter. Thanks again for your time, and wish all of you a very happy weekend.
Thank you very much. On behalf of General Insurance Corporation of India, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect.